Hey tax fam, if you're a medical professional and you probably already know that when it comes to taxes, it's not as quite simple as your everyday industry. So with this video, you'll hopefully get a better understanding of how it works. But we're gonna be doing something a little different in this video. Today I've enlisted Sean, an accountant from Box AS team, who you guys may have already met in the previous videos. I know you guys are sick of seeing my face, so I figured why not change things up? Okay, I admit it. Life's freaking busy. I just need some help with these videos, but don't worry, I'll still be in future videos, but just not this one here. So anyway, without any further ado, here's Sean.
Thanks, Davey. Hey guys, it's Sean here with another video of answering all your tax questions. Now, if you're a medical professional, you probably already know that when it comes to tax, it's not quite as simple as your everyday industry. But first, I want to stress that everything in this video is just general information and not to be taken as advice. Everyone's situation is unique, so I recommend consulting a professional. Okay, first things first. If you're a medical professional, you would most probably be an employee of a hospital or a clinic, or be contracted through your Australian business number, ABN. Occasionally, doctors and nurses also take on locum shifts, of which their income would be taken up by their ABN. When earning income through your ABN, you need to consider your structure. They could be number 1, a sole trader, number 2, a company, number 3, a payroll company, and number 4, a trust. In terms of cost, the sole trader structure is the cheapest and the simplest to operate, as there's little to no upfront costs and the accounting fees are cheaper. The other 3 structures are more expensive. Davey's covered this extensively in the past, so I won't go into detail, but there are quite a fair few costs for both setup and accounting fees, but plenty of advantages to make up for it. It's also worth noting that some hospitals require you to run through a payroll company or start your own company to invoice the hospital regardless. So, when starting your own company or trust, there is usually a set predictable fee. You would need to invoice the hospital to receive a recipient-created tax invoice, RCTI, from the hospital to receive payment. A payroll company, on the other hand, may garnish your wages from 2 to 4%, which is very significant, especially if you're a high-income earner. The benefit is that you would be a full-time employee under the payroll company's books and receive a wage. For example, if you are making $200,000 per annum, the fees for a payroll company at 3% is $6,000 per annum. So the more you earn, the less likely that a payroll company is the right structure for you, so starting your own company or operating as a sole trader may be more beneficial for you. Definitely speak to an accountant to get a better understanding of which structure will suit you best here, since the math will change depending on how much you earn. For doctors working for hospitals, there's usually no difference to taxes in any of the structures, as the income must be attributed to the doctor's individual name due to personal services income rules. If you're not familiar with PSI, it can get very complicated, so we've got a video on that if you want to know more. There are usually no ways around PSI, as servicing multiple hospitals is not regarded as running your own business in the ATO's perspective. Only medical professionals that start their own practice may be able to access the lower company tax rate being 25%. In this situation, you can also distribute the income through a trust. But we'll cover this in another video later. There are still restrictions and you must meet certain rules for the ATO to accept this. There are some doctors that locum as a trust and a company and retain or distribute the profits to different entities. But you have to be careful with the PSI rules in this situation. PSI and the anti-avoidance of tax rules may force you to pay out the profits earned in the company or the trust. There is a myth floating around that doctors can escape the PSI rules by setting up a company, but this is untrue. Since locum doctors cannot distribute their income earned to associates or retain their income in a company, it would be recorded under their individual marginal tax rate, the same tax rates you get when you're an employee or a sole trader. So, doctors are often in the 37 to the 45% tax bracket, That means for every dollar you earn above the threshold, you're paying 37 to 45 cents to the ATO. On top of that, there's Medicare levy and superannuation. This means you only take home half of the salary you earn. Another important side note, you should also consider an additional tax from Division 293. I won't go into too much detail, but in summary, Division 293 tax is an additional tax on super contributions, which reduces the tax concession for individuals whose combined income and contributions are greater than the Division 293 threshold. As of filming this video, this threshold is $250,000. The ATO will send you a notice of assessment if you do have to pay, but it can significantly affect your cash flow. So, it's worth looking into it as it may apply to you. I've left a link in the description below for more information about it. Now, for the fun part, saving money on taxes. We're going to start with salary packaging. Australia's health workers, doctors, nurses, midwives, and hospital and ambulance staff put in long hours providing critical services. In return, they're afforded exemptions such as salary packaging. But what is it? Salary packaging is an ATO-approved way of paying more of your everyday items and living expenses with your pre-tax salary as opposed to post-tax. This means it lowers your taxable income and increases your take-home pay, giving you more money in your pocket to spend on the things you want. Here's a quick example. Without salary packaging, you get your pay, then you get taxed, you spend on your everyday expenses, and that's how much you're left with. Let's say you earn $100,000 yearly and you get taxed at $22,900. Then you have your everyday expenses, which is $5,000. You're then left with $71,100. With salary packaging, you get your pay, then you purchase these expenses, and then you get taxed. Using the same numbers, you earn $100,000, but then you purchase these expenses being $5,000. That means instead of your $100,000 being taxed, it's $95,000. For this, with no further deductions, you'd be taxed at approximately $21,300. Of course, these numbers vary greatly depending on your situation, but you get the idea. There's a fair bit you can save from this, especially if you're in an even higher tax bracket. On top of that, FBT is a 47% tax on benefits that employers provide to their employees. For example, if the employer provides a business car to an employee, the private use portion of the value of that car would be taxed at 47%. However, there are exemptions for medical health workers of up to $9,010 in living expense items that normally attract fringe benefit tax or FBT. These items in many other sectors such as education and governmental departments are ineligible to do this. What this means is that if you're one of the million-plus Australians employed in the health industry, you could, depending on your employer, put $9,010 in tax-free dollars towards costs that you'd ordinarily incur anyway, such as groceries, utility bills, and mortgage or rent repayments. We only just scratched the surface, so once again, we recommend you to consult a professional and talk to your employer. Each individual hospital usually has set rules for salary packaging and the allowable items that employees can salary package. With that said, remember to always keep receipts on payments for those purchases so you can provide proof if you need to. Next up, we have salary sacrificing into your super. You can contribute up to $27,500 to your super. This means that up to $27,500 of your salary can be taxed at 15% from the super tax rate, as opposed to your potentially 32.5% to 45% tax rate under your personal name. It's a huge amount, so it's worth looking into. Here comes my favorite tax strategy. I heard from a friend, Debbie, who obtained advice from a financial planner about debt recycling. Debbie explained to me that debt recycling is when you replace a mortgage debt, a non-tax deductible expense, with an investment debt, a tax deductible debt. In Debbie's situation, she bought a house through a loan and is currently paying down her housing loan. The interest on the housing loan is a non-tax deductible expense as it is her home. Her financial planner advised her to redraw the paid-off equity using a split loan facility or a line of credit to invest in the Australian index funds. In this case, the interest on the split loan or the line of credit is tax deductible for her, reducing her taxes. On top of that, the dividends from her Australian investments had franking credits, which provided a tax offset to reduce her taxes further. I can't stress this enough. Debbie's case is just an example, and it should not be taken as financial advice. I am not advising you to purchase any investments. We're here to focus on the tax implications of different loan arrangements. When it comes to debt recycling and investments, please consult a financial planner and an accountant. The next thing is a more obvious one: tax deductions. As always, you can generally claim deductions on work-related expenses. You must have spent the money yourself and not be reimbursed. It must be directly related to earning your income, and you must have a record to prove it. Examples of potential deductions include professional indemnity insurance, medical journal subscriptions and publications, AMA or other medical professional association membership fees, the work-related portion of your phone expenses, and medical equipment and insurance for that medical equipment. You can also potentially claim car, travel, clothing, and self-education expenses, but these have highly specific rules. For example, you can claim car expenses when you drive between two separate jobs on the same day, such as driving between house calls. But you can't claim the cost of trips between your home and your work, even if you live a long way from your usual workplace, or have to work outside normal business hours. In some cases, you might even be able to instantly write off assets for income-producing equipment. I've left a link in the description below that goes in depth about this, so check that out to learn more. And last but not least, GST. Medical services are mostly GST-free, with the exception of cosmetic procedures which are not GST-free. However, voluntarily registering for GST can allow you to claim back GST on expenses. For example, if you went to a medical conference related to your work and spent, inclusive of GST, $1,400 for the conference ticket, $100 on food on the day of the conference, $500 for accommodation, $1,000 for the flight tickets, which add up to $3,000, you can claim 10%, which amounts to $300. Not bad. Again, this can vary from situation to situation. So check with your accountant to be sure you are getting it right. So, what are your tax obligations as a medical professional? If you are an employee, you will have to lodge your individual tax return on a yearly basis. If you're going down the ABN route, you'll have to do the following. First, start with a new structure, being a sole trader, a company, or a trust for your business. Set up the necessary registrations needed, such as your ABN, your TFN, and GST. For more information on this, we cover this in our video here. Next, set up your bank account. We recommend to always set up a separate bank account for your business and never use your personal bank account for this. Get relevant insurances. We have a video all about insurances too, so check that out. Next thing on the list is to set up contracts with your clients and set up your accounting software for your business. Additionally, always invoice your clients properly and when possible in a timely manner. Set up payroll and super for yourself if you're using a company or a trust structure, and then start lodging and paying taxes such as your BAS, your business activity statement, income tax, super, and single touch payroll. That was a lot. So to summarize, work out whether you're an individual employee or if you're a contractor receiving income through your ABN. Look into salary packaging, maximizing your tax deductions, salary sacrificing into super, debt recycling, and registering for GST. Once again, I am going to repeat that everything in this video is general and not to be taken as advice. Rules and results are applicable differently to every situation depending on countless variables. So I recommend consulting professionals for this. I hope you got something out of this video, and if you have any questions, leave them down in the comments below. Don't forget to like this video and subscribe to our channel for more business and accounting tips. See you next time.
So anyway, without any further ado, here's Sean. Wait 1 sec, let me see. Hey Sean, you coming? Can you put some pants on at least? All right.